What's up, everybody? This is our last show before Election Day 2020. Hope you and your families are doing well. We got a great show. We're going to talk about third quarter recovery, how the numbers are showing that the recovery is real. We're going to talk about how some people did amazing things with their stimulus money, and we're going to kick around a few other exciting topics. Thank you for tuning in. Hope you enjoy the show.
Welcome to the Money Huddle, a podcast that discusses financial topics for families, retirees, and small business owners. Hosted by Michael Baker and Ross Marinell. All opinions expressed by Michael and Ross or any podcast guests are solely their own opinions and may not reflect the opinions of Advisory Alpha. The podcast recording is for informational purposes only and should not be relied upon for investment decisions. Clients of Advisory Alpha may maintain positions in securities discussed on the program.
Michael, I've got good news today. I'm coming with some good news.
Let's hear it. I'm excited. You told me you had something. You weren't going to tell me. You were being a little mysterious. So
yeah,
let's lead with that out of the gate.
So popped open my laptop today and was welcomed with the news that McDonald's is bringing the McRib back for 2020. Come on now. If this isn't good news, first time since 2012 they were having national, every chain is bringing the McRib. If there was ever a time we need the McRib back, it's right now.
I would agree, because Lord knows one thing everybody's been doing in my household, or at least I should say me, for example, we've been stress eating. We've had no discretion on how many pizza nights we can have in 1 week. It's like, sure, pizza again, why not?
We're wide open.
Back.
So no holding back, right? No holds barred. We're gonna go eat up this McRib. Good for McDonald's. Let's get it back out there.
That might help them. When are they rolling it out?
Early December.
Early December.
Like December 2nd, I think.
Oh,
right around the corner, man. We'll be over the election, right? Hopefully, we'll have a president, and it'll be time to eat the McRib and just get into the holiday season.
McRibs for Christmas.
There we go. All right, so Michael, we had some GDP news this week. Why don't you tell everybody what happened?
Well, for anyone paying attention, the third quarter GDP numbers were not a surprise, but for a lot of folks, that don't deal with this day in and day out, it was kind of unknown until they announced it. But they had been expecting a really stellar third quarter GDP number, and we did get it. 33.1% was the number that was reported on Thursday, which that is an annualized number. And it just shows an incredible bounce back. Of course, I've seen people online trying to talk the number down and like, well, you actually need a greater recovery to get us back to where we were. I don't think anyone that's rational was expecting us to be back where we were. We still got this virus. We still are dealing with it. We still have states that have shut down and are not letting people go back to work. And of course, I think it goes without saying, until we can get children back in school, like full time, we're not going to have, people working full time because, parents and families have had to adjust, and that affects everybody. But it was a really positive development to see such a strong number come out for the third quarter.
That's true. So the quarter growth number was 7.4%. That's it was impressive. It beat expectations slightly. And that puts us basically from the end of the year still down about 3.5%. But given the dramatic issues that we had in second quarter, this was good news. It shows that we're on the right track. As you mentioned, there's still room to grow as we really sort of, fingers crossed, can get our economy unleashed in full come at least by next year, first quarter next year. I think we'll, it's hopeful and we're optimistic that we can have a full economic recovery from this.
I agree. And I think one of the things that needs to be stressed, or there are two things that need to be stressed, is number one is we're not out of the woods. I mean, we still have, things to go. This is, as we've talked about in the past, this is one of those inflection points in our economic history where companies that have been putting off upgrades and pivots to their business model, to their technology, they've been thrown full bore head first into the deep end of the ocean, and they're making those adjustments So we should expect to see some rotational shifts in industries. That's normal. It's just been accelerated. And number two is it shows the impact that the fiscal stimulus we had with the CARES Act, the PPP loans, the direct payments, that money helped. That was extremely powerful when combined with what the Federal Reserve was doing. And, I think we're going to have to see more fiscal stimulus, at least while we're still dealing with, this virus in this way. And so hopefully we will get some kind of resolution on that sooner than later, because I think that the longer that Congress delays on getting anything done, more people are going to become skeptical about, the strength of the recovery. And it's in everyone's best interest to not let the economy go down the tubes.
Right. So I want to pivot a little bit into some earnings analysis, and I want to come back to the stimulus money here a little later in the show. So this came across from JP Morgan today. I thought this was worth mentioning. So the title of this was Earnings Temperature Check. Don't miss your EPS. So it said, according to JP Morgan, 84% of S&P 500 companies beat earnings per share estimates this quarter. So that's a very high number. 84% beating estimates. It said, with so many companies beating, the ones that are missing are punished severely. So they had a chart showing relative one-day performance. So of the day that announcements are made, companies missing were dropping by an average of minus 3.4%. with not as much upside to those that were actually beating. Now, that's not true across the board, of course, because every company's reacted differently. But we've seen the majority of companies beat earnings and post some pretty good numbers, from Amazon to Google to Facebook, some of our largest, companies that drive return. And we saw a few that miss. So, for example, we saw Twitter miss on user growth. And what happened to their stock today? Well, as I look at Y charts, they're down a little over 18%. So when the misses came and the market perceived it as being a failure, there was pretty steep reaction taken.
Yeah, I mean, I think, at the end of the day, I mean, what's that famous quote? I think it's Munger or Buffett, but it says, in the short run, the market is a voting machine, and in the long run, it's a weighing machine. And I think right now people are voting on some of these companies because, there was massive fiscal stimulus. There was, the Federal Reserve got, extremely accommodating very quickly. And, some of these companies were offered, money to basically help them with operations and loans. And then other companies, I mean, they have access to capital markets. And, what everyone's looking for is, if you didn't perform, why? And some of these tech companies, like you were saying, like Twitter, that's a tough one because people have been been eyeballs to eyeballs on their technology here the last 6 months. It's one thing we haven't been able to divorce ourselves from. So,
right. So the earnings misses having a little bit more of a drawdown than historical. I'm sure all the things that you summarized there are leading to that. So I just thought it was interesting, that the majority of companies have been beating, which is great news. We've seen some pretty strong earnings reports come from multiple companies. Obviously, the areas that are still lagging are being punished. And so we've seen that over time. I mean, energy is still lagging. It is being punished. There are certain sectors that are not moving and having any forward progress that would be ideal. But that's not across the board. So that's a little bit on kind of what we've seen from earnings this week. A lot of S&P 500 companies reported. We're still
overwhelmingly positive, though, right? Overwhelmingly, over 84%
beating earnings per share
estimates.
But we're still seeing a consolidation this week. I mean, the markets are falling this week. That has a lot to do with the future of our country and where we're heading next year. The lack of stimulus this quarter before the election. There's a lot of things still to be settled, but some of our larger corporations have done well. And a couple were still kind of flat or iffy, but we'll see how the rest of the reporting come out.
Well, one thing that we were talking about before we hopped on the show was, and you mentioned that a lot of companies are struggling with issuing guidance right now, and I know that there are analysts and investors and traders or whoever you want to, whatever labels you want to use. There are a lot of people that are wanting to see, rock solid guidance, and that's got to be incredibly difficult right now to give guidance because there's so much unknown. We're getting ready next week to, have the official, our election day, and hopefully we'll have a very quick, decisive outcome one way or the other on the election process. We'll know the makeup of, we'll know who the president's going to be. We'll know the makeup of Congress, and we can then, put the pressure on those people in DC to like get some things done, and they can stop the political posturing. But right now, it's just in this specific moment in time, it's really hard when you got to say, hey, give us guidance. We're like, well, there's a lot of unknowns right now. So I think, and I'm hopeful that with some of this, political stuff clears up, some of these companies will get a little bit more clear about what directions they see, and how they're going to handle things ahead. And I think that will settle a lot of the market volatility down a little bit.
Sure. Okay. So moving on, Michael, what you got for us next?
Well, I saw a report, and since we've been talking about the economy and we're talking about the election, it was just a little video, and I'll put it up on our website. So with the podcast, so if anybody wants to go actually watch the video, but I thought it was a great little short video from Brian Westbury, who's a chief economist at First Trust, and he just made a little video talking about the election and investing, and he was essentially saying that a lot of investors have really become too married to this idea of their investments and politics. And he gave that reference back to, when Obama was elected in 2008, he said there were a lot of conservatives that just thought the world was ending, and that investing was done. And obviously, we had the financial crisis to jump over economically, but we saw this tremendous bull market that if you were in cash and you had moved out because you were afraid, you missed one of the, if not the greatest bull market in history, at least during our lifetimes so far. And he just said, it's really easy to get caught up in the emotion of the moment and be overly invested in the outcome of the election. But the long-standing things that matter are our market principles and our policies. And he says, don't be fooled. He goes, policies matter, but the historically it shows us that the best course of action for investors to take is to stay invested. Now, I'm going to add my caveat to that. That does not mean that you don't make adjustments to your portfolio and how you're going to tilt your investments. And if you're going to look at certain things more carefully than others, if you're going to be a little bit more moderate than aggressive, or if you are bullish on things and you want to be more aggressive, what that means is we don't pack up and go home and sit on the sidelines and say we're getting out of the market because we're nervous about this person or this administration.
So what he's suggesting there is we let our political biases cloud our investing judgment.
Absolutely. And if there's always going to be the next, as Nick Murray likes to talk about, the crisis du jour. Like he's like, there's always going to be something. It's the virus, and then it's the election, and then it's after the election, it's going to be, what about this? He said the media has become this machine that pumps us full of whatever negativity that they can, because that's unfortunately the way that we just see as people seem to be wired. That is what drives clicks, eyeballs, attention to them, and that is how they make money. They want the eyeballs, because if they have the eyeballs, they can sell the ads. And so the negative stuff is way more impactful for drawing attention than anything positive. And so I think that's the underlying theme is everyone's beating the drum right now. And I've seen the articles and I've refused to share them, but I'm sure you've seen the articles too, talking about if this candidate wins, the stock market's going to do this. And like, if there's one thing the market should have humbled us all to know by now, is that no one can predict what's going to happen. It's just the long-term trend is positive. Set your sail by that.
Right. It's a good reminder, because we do get emotional about these big decisions, right? Of who's going to lead the country, what political party is going to have control. And we kind of forget that American business, in a lot of ways, it just rolls on. Yeah, there are modifications. There could be modifications to the tax code, which could have an impact on performance, certainly, and profitability. But there's also still the ingenuity of sort of American business. Continue to innovate, continue to grow, continue to find pockets where you can expand. And in the big picture, just take a deep breath and let's look at the businesses and focus on those versus the political ramification.
I've said this before, and I'm not trying to be polarizing, but the smartest people in our country do not work in DC. They work in the private sector, and they're going to figure things out. That's what they do. And so, what I'm hoping for, though, I think is just for this election to pass and everyone to take a breath. I think that's what 2020 needs right now, is a deep breath.
We need a McRib.
Touche. All right.
Take a deep breath and a McRib. All right. So let's move on. So, we've had some discussion today about stimulus. There was a lot of discussion between Mnuchin and Pelosi to try and come up with the second round of stimulus, which may have included their discussions, another direct stimulus payment to Americans that qualify based on their income. And there's been some data that's surfaced over the last couple of months about how Americans spent their first round of stimulus. And this caught our attention because now I'll read this to you. So this was a working paper by 3 economists. So this article was on theeconomist.com. It said, using data from a recent survey of 12,000 Americans conducted by Nielsen, a market research firm, the authors found that just 42% of the money was spent. Another 20% was saved, and the remaining 31% was used to repay debts. Pretty remarkable that during this time of pandemic, fear, concern over job security, transition from office work to work from home, that still a good chunk of the money that was distributed as quote unquote stimulus was used by people to clean up their balance sheets, pay off debt, save a little money.
I think it's fantastic, to be quite honest with you. I mean, we were talking about this before, and one of the things we do as people, we do mental accounting, and depending on how things get framed and put to us, depends on how we see the funds. Also, the size of the check. It tends to be human nature. The smaller the check, the more likely it is to be spent, and the larger the check, there's a good chance that money is going to be used more prudently, because it's people are looking at it like, wow, this is truly something I can't blow this. I need this to do, to make a wise move with it. And I listened to that, and it was like, I told you, I'm working on this project right now, and I'm doing a report on this book, and it says why smart people make big money mistakes. And I was saying it's an exercise in framing and how things are framed. And in the book, they use an example of college students that they were put it together in a study, and these college students were going to receive $25 back from the bookstore. And the group that was given, half the group was given $25, and they said it was a rebate. And then the other half was given their $25 and said it was a bonus, just for patronizing the bookstore. And 84% of those people, or the kids that were told it was a bonus, spent the money. And 21% of the students that had the money described as a rebate spent it. So similar idea here at work with these stimulus payments. There's going to be people that see it as like, a bonus, and then you have people that pay a lot in taxes and they get this money back and they kind of see it as like a rebate of their taxes, right? And
Right.
they're more apt to do something. They're not more likely to spend it. They're looking at, hey, I'm getting my own money back from the government. And I think that is indicative of those results that you were just sharing with us.
So even though it was framed as a stimulus check, which the government, framing for us to spend, I don't know that that's how everyone felt when they received it. And so clearly by the way the money was spent, it was treated much more as a rebate of filling a very, very necessary gap. And even if you look across this chart, I mean, this starts with income house, it says stimulus payment used by household income and percentage. So even from 5,000 to 100,000, a portion of that money was used for debt payments and savings. And if you look, I'm just looking at this column here, 50,000 to 59,999 in income. Over 60% of the money, or right at 60% of the money, was used to repay debt or save. So you can see how just prevalent that reaction was, that we just held on to that money.
Which I think is great, because one of the things that, if you think about it too, and this probably has a bigger role than we are giving it credit for, that money came out, or that decision was made early in the game, especially we're sitting here, October, November. That decision to send out stimulus money was made a long time ago.
Right.
And there was a high degree of uncertainty. Like, how long is this thing going to last? And I think that probably drove people to, maybe put it in their savings or shore up, their cash flow by paying off credit card bills, things like that. And so maybe the uncertainty of the environment for a lot of folks, like you were saying, drove people to make more prudent decisions.
Right. Now, if they wanted us to spend the money, they need to send it before Christmas.
Oh,
hey, the next stimulus check may not go, into the savings bank. We might just uncork it and go buy some stuff. I don't know.
If they want people to spend it, then probably the better thing to do would be to dole it out like $500 a month or something for 3 or 4 months. And people spend that or save that. I'm not sure, but it's a great, this will be, I can assure you that this scenario will be studied by behavioral economists, behavioral finance people, psychologists, the whole thing. Once we're through the woods and people can just get the data and they can kind of pick apart what's going on and why people made the decisions. This will be a case study in the future. I guarantee it.
So what else? Do we have anything other topics today?
I did. Actually, I had one other thing I was going to share. And we talked about, if you remember in our last show, we talked about the hidden or forgotten, household asset, and that was guaranteed income. And we talked about how Allianz, good old Allianz, they're in the retirement study, Hall of Fame. They're constantly looking at how people look at stuff. Well, there's a new study out by Allianz, and it was saying that Generation X was interested in guaranteed income, and they have Generation X framed as people that were born between 1965 and 1980. And it said they were doing qualified retirement plan. They were doing studies on plan participants, and it said around 70 of all the groups, 71% would like an option that would provide guaranteed income. And of those numbers, 75% of Generation X said they were interested. And if you remember, we just had some legislation passed not that long ago, the Secure Act, which was going to pave the way for annuities to get into qualified retirement plans. And this is something that you and I have been watching, because we know that these insurance companies are licking their chops to get access to these 401k dollars, because the plans, generally speaking, are they're constantly being fed new dollars, and they're going to get in there and they're going to compete with the target date funds and the mutual funds that are typical, or ETFs in some circumstances that are the typical menu of products. What are your thoughts on that when you hear that? What's the first thing jumps out at you?
Well, I am Gen X. It's not what I roll out of bed and think of when I think about saving in my 401k. So I don't know how that study is framed. I would be curious to look into more of the detail. Listen, the reality is we don't, as we've discussed in the past, the defined benefit plans like a cash balance pension plan that would provide some type of guaranteed income at retirement is just far less prevalent. And so we are, almost exclusively responsible for our own retirement savings. And that becomes a challenge, right? Because it's the income that we defer today that grows to become the income that we rely on in retirement once we are no longer working. And there is an appeal of finding an alternative to create that guaranteed income when it doesn't really exist through the employer benefit plan relationship, right? Which is what's happening. Many people that are working today in a younger age group don't have a defined benefit plan to contribute to. So can you create one on your own through your own, defined contribution, whether that's a 401k plan or something similar, to kind of give that alternative? And I think as Gen X continue to get closer to retirement, that will become more and more important. Sitting here today in my mid 40s, I'm still very much focused on growth and equity accumulation. Now, I don't know how everyone else feels, obviously, within that age range. And I could be a little different because I'm closer to the industry than most people are. But the reality is, besides Social Security, which a lot of younger people don't feel confident in, how else do you guarantee some level of income? So it's certainly a mounting concern. And I don't know, truthfully, if Gen X is there yet or not, but maybe getting closer.
I would agree, and I mean, I like that there's an effort to create innovation. But my first couple of thoughts when I saw that, I was like, number one is, I do know that there are some groups out there that are really working hard to provide financial education to 401k plan participants. There's some great people in that space that are trying to do it. But I would say as a whole, my experience in dealing with folks that are, that have 401ks, they have very little, people prodding them for educational, trying to help them, determine things. Now, maybe that'll change. And so introducing something like annuities that is commonly misunderstood and maligned in our business only is going to create additional confusion. The other thing that really concerns me too is this low interest rate environment that we're in is it has an impact on pricing on those products. And, I don't know that we're going to see this a run up in rates where those, some of those things, some of those contracts and products will be priced very attractively. Now we'll have to see, right? But I thought that was interesting in how, Generation X, which the older Generation X, they're in their 50s, they're probably starting to look at, see retirement coming over the horizon, and the idea of guaranteed income is growing in appeal. That's like any generation. I'm sure there's a dispersion because the people on the younger tail of that probably aren't thinking about retirement as much as people that are closer to the fire. So it would be interesting to see how those responses broke down by age within the generation. But I thought that was interesting. And what I would encourage anybody is if you have a 401k, if you're a participant in a 401k plan and you don't have an advisor that's helping you or a planner, find yourself a qualified planner that can give you objective advice and help educate you on your options, how the plan works, especially if they introduce new features to the plan. Ask questions, educate yourself. Don't just roll with it. Don't just read the brochure. Understand and know what you're purchasing, because other than your house, right, for most families, the largest asset in the household, is the 401k balance, is your retirement, so this is something that should be guarded, and you should make calculated and educated decisions with. So that's what I would say is, as legislation opens up the area for this space to innovate and create new products, don't go into that naively. Ask questions and educate yourself.
Cool. All right. Full agreement.
Well, this has been an interesting week. Of course, this is like the calm before the storm. Next week we have election day.
This is the storm before the storm, Michael. We're in the storm before the storm.
That makes me feel so warm and fuzzy on the inside. But hey, what else can we expect from 2020? It's Halloween this weekend. This year has been a doozy. We just encourage you guys to hang in there. Like anything else, this is a crazy times, crazy season. We'll get through it. Be mindful of what drives investment returns over the long term is first and foremost good investor behavior. Don't shoot yourself in the foot. Don't react emotionally. If there are things that concerns you have, questions you have, reach out to our team or reach out to whoever you're working with. Get some guidance and think through your plan and make adjustments. Don't have to throw the baby out with the bathwater, but if making some adjustments will allow you to sleep better, then definitely explore that. We would encourage that. And Ross, you got anything to add?
No, that's it. This will be our last podcast before the election. Fingers crossed. So we have a safe and decisive outcome. It will help, I think, us move forward.
Amen to that. As always, thank you guys for listening to the show. Feel free to find us on Spotify, find us on Apple iTunes, in the podcast app. Reach out to us if there's a topic you'd like us to discuss on the show. The Money Huddle at vcplanning.com. And we'll talk to you next time.